Okay, so have you ever thought about it like this, right? You know that feeling, like when you think about the possibility of like your money not only growing, but also potentially like giving you income down the line, but like without having to worry about taxes.
Oh, yeah.
It's like the dream, right?
Yeah.
Like a financial holy grail or something.
It is. It is. A lot of people are looking for that.
Exactly. And that's exactly what we're diving into today. We're exploring the world of indexed universal life insurance policies, or IULs for short.
Right.
And we're doing this deep dive based on a YouTube video by Doug Andrew called Designing the Perfect IUL Policy, a step-by-step guide, from his channel, Doug Andrew 3-Dimensional Wealth.
Yeah, that's a great video. So we're trying to understand like how he thinks about this idea of an IUL being designed specifically for, building tax-free cash that you can actually use while you're alive, not just as a death benefit. He calls these living benefits.
Right, exactly. And it's interesting because, Doug Andrew has been in this financial world for a really long time, like 5 decades. So when somebody with that kind of experience starts talking about IULs in this way, it makes you wonder what shifted in the financial landscape that led him to become such a strong advocate for this particular way of using IULs.
Yeah, well, that's a great question. And it's really interesting to look at his journey, right? He actually started his career advocating for that classic buy term and invest the difference approach.
Right.
Get the cheapest term life insurance you can find and then take all that extra money you would have spent on a more expensive policy and put it into like mutual funds or something.
Yeah. Makes sense.
And his reasoning was that the stock market historically has had the potential to like generate higher returns compared to what you would typically see with a whole life insurance policy. He even mentions Delbar statistics showing that the average stock market return before taxes is something like 9.14%.
Oh, wow. Okay.
Yeah. So, it's pretty decent. And the logic seemed really sound back then. Cheaper insurance, and you get the chance to potentially grow your money faster in the market.
Right. But then he talks about how the real game changer is taxes.
Exactly. That's where the buy term and invest the difference strategy can sometimes fall short,
Yeah.
Because even if you're getting those nice returns in the market, a big chunk of it can disappear once you factor in things like taxes and management fees.
Oh, I see. So it's not just about the gross return. You have to consider what you actually keep after all those deductions.
Yeah, exactly. And he illustrates this with a pretty clear example. Like, imagine you're earning 12% on your investments. That sounds fantastic, right?
Yeah, absolutely.
But then you take into account, let's say, a 33% tax bracket, plus those pesky management fees that can eat into your returns.
Right.
Suddenly that 12% can dwindle down to a net return of just 7%. That's like, poof, almost half of your gains have vanished.
Yeah, that makes a huge difference. So that must have been like a light bulb moment for him.
Yeah, and this brings us to 1980, when E.F. Hutton introduced universal life insurance, or UL. This was a game changer because at that time, interest rates were really high.
Okay.
And these UL policies offered the potential to earn like 11% or more. And the cool thing was you could net around 10% because that small 1% difference covered the insurance costs. And get this, the growth was tax deferred.
So basically you were getting really good returns without having to pay taxes on them right away.
Exactly. It was like having your cake and eating it too.
Yeah.
At least from a tax perspective. But then, as you know, interest rates started going down over the years. And that's where indexed universal life, or IULs, came into the picture. They were designed to maintain that potential for really attractive growth, even when interest rates weren't as favorable.
Okay, so how do IULs actually do that? Like, how do they link their returns to the market when interest rates are low?
Well, the idea is to tie the policy's performance to a specific market index, like the S&P 500. But a lot of IULs also offer a really important feature, downside protection. It means that if the market takes a dive, your cash value won't necessarily drop with it.
That's interesting. So even though you're participating in the potential upside of the market, you're not directly exposed to the same level of risk if the market goes down.
Exactly. And Doug Andrew says that, with his IULs, he's earned an average of 11.17% since 1980. And he's gotten a net cash-on-cash return of over 10% through things like rebalancing and diversification.
Wow, those are some impressive numbers. Okay, so it seems like the appeal of IULs, especially during those times, was that they offered potentially good returns with some level of protection from market volatility.
Right. You have to think about the economic context too, right? Back in the 80s, the stock market was going through some pretty wild swings.
Right.
And for a lot of people, it was really unsettling.
Yeah.
So the idea of moving some of their money into something that seemed more stable but still had the potential for strong tax advantage growth was like incredibly appealing.
Yeah, I can see why. So let's talk more about the tax advantages of permanent life insurance, like IULs. This is a core concept he keeps coming back to, and it's not exactly a new thing, right? These tax advantages have been around for a while.
Yeah. Doug Andrew makes a point of saying that this idea of tax-free accumulation inside a permanent life insurance policy has been part of the Internal Revenue Code, like the IRS tax code, for over 100 years.
Wow, over 100 years. So there's a pretty solid historical basis for these tax benefits then.
Yeah, exactly. And the idea back then, the philosophy behind it, was that if people took responsibility for their own financial security, especially for their families, well, that could potentially lighten the burden on the government. So these tax advantages were kind of like, an incentive for self-reliance.
I see. So it was about encouraging people to be more self-sufficient financially. And that was seen as a positive thing, both for individuals and for society as a whole.
Exactly. And it's not just like a vague concept either. These advantages are spelled out pretty clearly in specific sections of the IRS tax code.
Okay, so what are those specific sections?
So Doug Andrew mentions three main ones. First, there's Section 72E, which basically says that the interest, dividends, and all that growth inside your policy's cash value can accumulate tax-free. Then there's Section 7702, which is really important for this whole idea of living benefits because it allows you to access your money tax-free while you're still alive.
Got it. So that's a big distinction from a traditional life insurance policy where you only really benefit from the death benefit after, well, you're no longer here.
Exactly. And then, of course, there's Section 101A, which makes sure that the death benefit itself, the money that goes to your beneficiaries, is also received income tax-free.
So you've got tax-free growth, tax-free access while you're alive, and a tax-free death benefit for your beneficiaries. Doug Andrew makes a pretty bold statement, claiming that there's no other single financial tool out there that offers all three of these advantages.
Yeah, that's a cornerstone of his argument.
Yeah.
And he really drives home the power of those tax advantages, especially the tax-free compounding, by using a pretty compelling example.
Okay, what's the example?
Imagine you start with $500,000, and let's say you're getting an average net return of 9.6%. According to his calculations, that money could potentially grow to $8 million tax-free over a 30-year period.
Whoa! $8 million from $500,000 in 30 years? That's a pretty significant increase.
Right, and he even breaks it down using the rule of 72. That rule that says to figure out how long it takes for your money to double, you just divide 72 by your rate of return. So in this case, if you're getting that 9.6% return, your money would be doubling roughly every 7.5 years without taxes eating away at it.
Okay, I'm starting to see why this whole concept is so appealing, but with all these potential benefits, I have to ask, did the IRS ever try to, put some limits on these tax advantages?
They sure did. As the popularity of using life insurance for these living benefits grew, the IRS started taking notice. They began to question whether policies that had these really large cash values but comparatively small death benefits were really aligned with the original intention of life insurance, which was, to primarily provide a financial safety net for your family after you die.
Right. Yeah, that makes sense. They were probably concerned that people were using these policies more as tax shelters than as actual insurance.
Exactly. And they specifically started scrutinizing companies like E.F. Hutton, who were really out there promoting universal life for its cash accumulation features.
So what happened with that scrutiny? Did the IRS succeed in changing the rules?
Well, it's interesting. In the actual court case, E.F. Hutton won. The court decided that what they were doing wasn't violating the existing tax laws at that time. But the IRS wasn't giving up.
Okay, so what did they do?
They went straight to Congress, and they started lobbying hard to get the rules changed.
And were they successful?
Oh, absolutely. That's where we get those acronyms that we hear a lot in the world of life insurance. TEFRA and DFRA.
Okay, I have to admit, I've heard those terms thrown around, but I'm not entirely sure what they actually stand for or what they mean in practice.
Yeah, they're definitely a mouthful. TEFRA stands for the Tax Equity Fiscal Responsibility Act of 1982, and DFRA is the Deficit Reduction Act of 1984.
Got it. So while the acronyms might not be super clear, they definitely had a big impact on how life insurance could be structured for those tax advantages. What exactly did they do?
Well, essentially, they established this really important link between the minimum death benefit a policy had to have and the total amount of money that you were putting into it.
Oh, okay. So the more money you put in, the higher the minimum death benefit had to be to keep the policy's tax advantage status.
Exactly. It was all about making sure that there was a genuine insurance component to the policy, and that it wasn't just being used as a way to stash away money and avoid taxes without actually providing any real death benefit protection.
Right. So they were basically closing that loophole, or at least making it a lot narrower. So how does this whole concept of self-insuring that Doug Andrew talks about fit into all of this?
Oh, that's a really interesting point. The idea of self-insuring in this context basically means that as the cash value inside your policy gets bigger and bigger, the insurance company's actual risk, the net amount at risk, decreases. Let's say you have a policy with a $1 million death benefit.
Okay.
And let's say you've built up $500,000 in cash value inside that policy. Well, in that case, the insurance company is really only on the hook for that remaining $500,000.
Oh, I see. So the more cash value you have, the less the insurance company actually has to pay out if you were to pass away.
Right, because a portion of that death benefit is essentially already covered by the cash value that you've accumulated. And this can potentially lead to lower insurance costs over time.
That makes sense. Okay, so we've covered a lot of ground here about how these policies work and the tax advantages. Let's get into the nitty-gritty of how to actually design an IUL to really maximize those living benefits that Doug Andrew keeps emphasizing. What's the main goal here?
Okay, so the ultimate goal is to put as much money as you can into the policy, to max fund it, while still staying within the minimum death benefit requirements set by those rules we talked about, TEFRA and DEFRA. He calls this creating a tax-free cash cow.
A tax-free cash cow.
I like the sound of that. So how does someone's age factor into all of this? Like, does it make a difference in how much insurance they need to have relative to the amount of money they want to put in?
Yeah, age is actually a really big factor. TEFRA and DEFRA basically created this sliding scale where the older you are when you start the policy, the less initial life insurance coverage you need to have for the same amount of money you want to put in. So it's actually advantageous to start later in life if you're primarily focused on those living benefits.
In a way, yes. Doug Andrew gives this really interesting comparison. He says, imagine you're a young person, like 22 years old, and you want to put $500,000 into an IUL. You might need to have a death benefit of like $5 to $6 million to make that work.
Wow, okay.
But then he compares that to someone who's, say, 60 years old, wanting to do the same thing, put in that same $500,000. They might only need to have around $1 million in death benefit coverage.
That's a massive difference.
It is. He even tells a story about a 78-year-old client who had some health issues, but was still able to put $500,000 into an IUL with only $700,000 of insurance coverage.
Wow. So even with health challenges, he was able to get a pretty significant amount of money into the policy because of his age. And it sounds like in his case, he was really focused on using the IUL for that tax-free income.
Exactly. That's a perfect illustration of how age can play a big role in this strategy.
Yeah.
The older client was able to really prioritize cash accumulation and that potential for tax-free income because the regulatory hurdles, those minimum death benefit requirements, were much lower for him because of his age.
So that makes a lot of sense. He also talks a lot about the importance of having a level death benefit when you're designing an IUL for living benefits. What does that mean exactly, and why is it so important?
So with a level death benefit, the cash value you build inside the policy is actually considered part of the overall death benefit.
Okay.
So let's say your death benefit is set at $1 million and your cash value grows to $500,000. Well, the insurance company's net amount at risk is only $500,000 because the other half is covered by your cash value.
Right.
And as your cash value keeps growing, that net amount at risk for the insurance company keeps going down, even though the total death benefit stays the same.
I see. So they're essentially only responsible for paying out the difference between the death benefit and the cash value you've accumulated.
Right. And this can potentially lead to lower insurance costs over time because the insurance company's risk is decreasing.
Okay, that makes sense. So there's this other acronym he mentions, TAMRA. What is that, and how does it fit into all of this?
Oh, yeah. TAMRA stands for the Technical and Miscellaneous Revenue Act of 1988. And it's really important because it basically sets limits on how quickly you can put money into the policy.
Oh, okay. Why are there limits on how fast you can fund the policy?
Well, if you put in too much money too quickly, the IRS could classify your policy as a modified endowment contract, or MEC, which is not good.
What's so bad about an MEC?
Well, a MEC loses a lot of those valuable tax advantages we've been talking about. Like if you take money out of an MEC, it's taxed as ordinary income first, and you might even have to pay penalties. It's kind of similar to how those non-qualified annuities are taxed.
Oh, so you want to avoid the MEC classification at all costs if you're trying to maximize the tax benefits of an IUL.
Exactly. And to illustrate this whole concept of funding the policy at the right pace, Doug Andrew uses this really interesting metaphor about a 5-story office building.
Okay, I'm intrigued. Tell me about this office building metaphor.
So picture your IUL policy as this 5-story office building, and your premium payments are like filling up each floor of the building.
All right, I'm following so far.
Now, the IRS, through TAMRA, basically says you can't just fill up the entire building all at once, right in the first year.
Okay, so you have to spread out your contributions over time.
Exactly. And in Doug Andrews' example, a good strategy might be to fill up one floor, which is 20% of the building, in the first year, then another floor in the second year, and so on. It takes at least 4 years and 1 day to fully fund all 5 stories of your office building.
So by gradually funding the policy over time, you avoid that MEC classification and keep those tax advantages intact.
Exactly. And all that rental income that you get from your fully occupied building, that represents the policy's growth and your ability to take tax-free withdrawals later on.
Okay, that's a really helpful way to visualize it. So it seems like the common mistake people make is trying to put a big lump sum of money into the policy all at once, which can trigger that MEC classification.
Yeah, and Doug Andrews says that a lot of times insurance agents will try to accommodate those big upfront contributions by increasing the death benefit on the policy, which actually goes against the whole principle of keeping the insurance as low as possible.
So they're essentially over-insuring their clients just to fit in that lump sum payment.
Exactly. And Doug Andrew argues that instead of inflating the death benefit, you should spread out that lump sum over the first few years of the policy. That way, you can still get the maximum amount of money into the IUL, but you keep the required death benefit as low as possible.
Right. So you're not paying for more insurance than you actually need, which it can really eat into your returns over time.
Yeah, and he actually put some numbers on the potential cost of doing it the wrong way. He says that even if the market performance is the same, you could end up netting around 10% with a properly designed IUL, but only around 7% with a policy that has too much insurance.
Wow, that 3% difference might not sound like a lot, but over time, it could make a huge difference in how much wealth you accumulate.
Absolutely. And it can significantly impact the amount of tax-free income you can potentially generate from the policy down the line. So those design details really matter.
Okay, so it's all about striking that right balance between maximizing your contributions and minimizing the death benefit to really harness the power of IULs for those tax-free living benefits.
Exactly. That's Doug Andrews' whole philosophy in a nutshell.
So, to wrap up our deep dive on Doug Andrews' perspective, it seems like the key takeaway is this. If you design an indexed universal life insurance policy strategically, focusing on getting as much money into it as possible, but with the least amount of insurance coverage required by the IRS rules, it can potentially be a really powerful tool for building wealth and creating income, all on a tax-advantaged basis.
Got it. That's the big idea he's trying to get across. And he really emphasizes that it's about understanding those intricate design principles and avoiding those common pitfalls like overinsuring. Because if you do it right, an IUL can potentially offer some pretty substantial tax benefits as you're working towards your long-term financial goals.
It's definitely a lot to think about. Makes you wonder, are your current financial strategies really doing everything they can to help you minimize your taxes and keep more of your hard-earned money? Could this approach, focusing on strategic funding and minimum necessary insurance be a better path for you? It's definitely a question worth exploring.
It is. It is.
And for those who want to dig deeper into Doug Andrews' thinking, he actually has a special offer. He mentions his book, The Laser Fund, which is like 300 pages long and covers, all the technical aspects of this and how to apply it in real life. He's giving away a free copy at laserfund.com. All you have to pay is the shipping and handling, which is like a nominal fee.
Yeah, that's a great deal. And he also says they have the book in audio and video formats if you prefer that.
Right. And if you want to go even deeper, he has a longer masterclass, some free webinars, and you can even schedule a consultation with a certified IUL specialist if you want personalized advice. So there are lots of resources available for anyone who wants to learn more.
Yeah, and that's really encouraging because it emphasizes the importance of being proactive and really understanding these financial tools before you make any decisions. Ask those tough questions, do your research, and really make sure you're comfortable with the approach before you jump in. It's your financial future, so it's worth taking the time to get it right.
Absolutely. Well said.